So they're the my intro wasn't recorded in Bali. Thanks a lot, though. They've done everything in the background. As I said, from the banner behind me to the links, slides, you name it, they've just been phenomenal. And I appreciate that. I think as a word of mention, during the week, our digital marketer at Finance had said to me, that banner looks proper, and she does a whole lot of big work. So thank you for that. And thanks for not compromising on that. I'd like to welcome you, the guests, our audience. I hope this series has been very informative for you, and hopefully we can cap it off with this presentation. Very short one, but very short and impactful because it brings it all together. So I hope you'll fasten your seatbelt and enjoy this one. And then lastly, I think Bali, you can now officially mention that I'm an RE5 holder, meaning that I am within the law by phase, the Financial Advisory Intermediary Services Act to actually give financial advice. So I think you're speaking to someone that not only knows what he's talking about, but actually has been given permission by the President of South Africa to do so through his laws and what you lawyers say. Thanks for that. Um, I don't know, Bali, should I just go straight in or give back to you or Tumelo? I know your events are often very well emceed. I don't want to get into the program when you've got starters.
So please continue, and then we'll hand over to Dumelo for the question and answer afterwards.
Okay, no problem. I'm just going to share my screen. I think give me those powers. And what I'll be doing is I'll just be starting with a recap because if I go straight into index funds, compounding, and emergency funds, as I said, it is a short but very jam-packed session. It brings a lot of the concepts together that we've been through. So if I don't recap, I think you can find yourself quite lost. I'm gonna try again. There we go. Thanks a lot, Mbali. I'm able to share screen now. Right. So, as you guys will remember from the first session, this series started up as the five concepts to make you wealthy, the five financial concepts. I didn't invent them. I didn't even discover them. So, I'm not even the Christopher Columbus of these concepts. My friends at Just One Lab, the Fat Wallet Show, Christian van Heerden and Simon Brown actually, let's say, discovered the concepts in terms of they were lying there everywhere in finance, and they decided to actually put them together so that anybody who says, listen, just give me a crash course on finance, what do I need to know? And then they created these concepts, or they discovered these concepts and put them in a manner that I can now show off for having presented them to you. I've added a few, I've taken away or adjusted a few. I won't point out which those are because I still primarily want them to get the benefit of having discovered them and put them up for us. But I'll just take us through, especially what we've been through, just for 2 minutes quickly, and then go into today's program, right? I do also apologize to the marketing gurus in the group. I also apologize to yourself, Mbali and Dumelo. Um, I butchered all the laws of marketing and branding and what have you. So you'll see my slides have one theme, then the next theme, then the next theme. So let's untwirl in that regard. I don't take it for granted. All right, let's go. So the first thing that we spoke about in the first week was assets, investments, and liabilities. You'll remember we spoke about how assets essentially retain the value of your money or the real value of what you've worked hard for. Then investments look to increase that over and above just the asset value. And then liabilities are essentially trying to chip away at that, to eat away at that. We discussed how, for example, when you buy a house, your verpa, when you splurge, that sort of a thing, always differentiate between the two financial instruments at play. Your house is still an asset, despite what myself and Robert Kiyosaki have tried to tell you over the years. It's just the mortgage on it is a liability. The sooner you pay off the mortgage, the sooner you've got an asset that does not have a liability eating away at your funds. Investments, as I said, they speak for themselves. It's essentially assets that generate income and look to generate income far beyond inflation, which took us to the next point, which was inflation itself. Inflation is essentially that gap between value and the price of things. And the reason we have that gap is because in 1971, the US government decided to temporarily move away from the gold standard, meaning that for a while in 1971, they wanted the US dollar to stand on its own and gold to stand on its own without the two approximating their value in one another. But the term inflation was then invented or created to capture that difference as to how far away we are from the gold standard, so that when we get back, we try and bridge that gap. Obviously, we're in 2023, so it's what, some 52 years later, and we're still temporarily away from the gold standard, and a sobering fact that we may never return, right? Just trying to get them to, there we go, to the next one. Then the following installment, I think it was June, July, we spoke about incomes, expenses, interest, and dividends. I think to note there, we spoke about the different returns that you get from the interest. We spoke about government bonds, retail bonds. We spoke about ESCOM and ESCOM bonds and how you can take ownership of ESCOM, as well as how the government may essentially never allow ESCOM to default. And what does it mean when they say government stands as a guarantee for state institutions like ESCOM? I think I showed you how to calculate dividends on companies when you're buying them, as well as expenses and incomes. We spoke about the spending patterns of the rich versus the middle class and the poor, right? No political term, just in financial terms. In Bali, something's still popping up here for me to admit them, nah? If it's not popping up on your side, perhaps just there we go. Yeah. All right. Thanks a lot. Then I think from there, we then come to today's session, how it all comes together, right? After learning about assets, investments, liabilities, the expenses, the dividends, the incomes, you may be sitting there thinking, okay, now what do I do? Where can I buy these investments? I hear you on the assets. They're gonna keep the value of my money, but I don't really have much for it to be kept at the moment. I am looking for something that will increase the value of my wealth, that sort of a thing. And that's where index trackers come in. And that speaks about its investment vehicles. And you'll see when I discuss the index trackers themselves. Here is just the recap of what we're going to look at. Essentially, it's low cost, it's diversified, and gives you access to the market. And the way it does that, like at school when you had a top 10, you always knew that there's going to be a top 10, even though the people inside it might change, they might move around, that sort of a thing. That's what index trackers are. You essentially are saying that I'd like to make a monthly investment into the top 10 companies in the economy. That may fluctuate as the stock market fluctuates, but you never have to worry about that because at any given point in time, you are holding the top 10. And then lastly, but not least, you'll see at the very top of the structure is what we call compounding. Put quite simply, I don't think any of our minds can quite grasp how powerful compounding is, but I hope today's session can bring you a lot closer That is essentially returns on returns on returns on returns on returns. So your investments generate the return, you reinvest that return to buy more investments, and those investments generate an even bigger return. And essentially that keeps on going to a point where your individual contributions can't match that. And that gives us the five concepts to financial freedom. If you grasp these, you are more than halfway there to your financial journey. I even venture to say you're about 80-90% there. And today I will touch on emergency funds. And if we do have time, a bonus on equity and capital. Those have got nothing to do with the five concepts. Emergency funds, I touch on it because that's like your insurance policy for the five concepts to be playing in the background. I'm now going to jump straight into the presentation on index funds. Just bear with me. I am moving at my tech fastest in between slides and presentations and share screen. I also did take note of the feedbacks. Someone asked that, can we have a 5-minute body break? That was in the previous session. I think you'll be happy to know that today's body break will essentially be the end of the session. And then someone else asked, may we please take questions within the webinar? And I think I'm more than happy to do that. I will state upfront that I've got no way of identifying that. So I think Bali, Tumelo, you guys can just look out for that. And then where a hand is up, at least when I get to the end of the sentence or point, you can just jump in and then I'll be happy to take the question, right? Index trackers. Index trackers, essentially we're talking about the investments that you can only make in your TFSAs, your tax-free savings accounts. A lot of people keep their money in cash. That is an absolute waste of an opportunity to generate more money. Essentially, by keeping your money in cash inside a TFSA, you are buying an inefficient asset, which is cash, right? Because the return on cash will always be whatever the interest rate you're being given. Now, if your index tracker is with easy equities, and I put an asterisk because those of you that have me on WhatsApp, you'll note that I'm currently having a conversation with easy equities. They're introducing a monthly fee. I'm not a fan of it. I'm not saying go anywhere else. I'm not going anywhere else. But they basically have gone from being my favorite service provider to being a service provider. But we'll sort it out. I've been through this journey with them, I think, for the last 10 years. They tend to listen, and where they're stubborn, they tend to convince me that they're correct. But if you're holding your TFSA with one of the banks or one of the other financial service providers, you often will get what mimics the interest rate, and often that is quite below inflation, meaning that you're just holding an asset, and that asset is losing value with the difference between the interest rate and inflation. So normally we advise that you rather buy ETFs. That's the only thing you can buy in your tax-free savings accounts. You can't buy individual shares. You can't buy bonds, that sort of a thing. And so you do that. What are ETFs? We will touch it. We will touch on it shortly. Essentially, it's exchange traded funds. And as I did mention, you're buying the top 10 or the top 50, or I know 5 years from when the industry first blew up, we now sit with any banner that you want. There is an ETF for it. So if you say, I'm only interested in green investing, as you can see our little penguin over there, there's an ETF for that. All it is it's a tracking of lists, but we will see that when we talk about it a bit more. I've got the 8-year-old explanation, then I've got the 25-year-old explanation, and then while I was sleeping last night, I thought maybe there should be a teenager explanation of it. The teenager explanation of it is the top 10 at school, actually. So I went with that simply because when you see the 25-year-old's explanation of what an ETF is, I think you will agree with me that teenagers kind of have this lingo thing sorted out. Most of the index trackers also exist in your retirement annuities, and a lot of that is because of reg. And I always get it wrong, is whether it's regulation 28 or 27. I think I grew up on 27, it's now 28. So it grew up too. I've done a 4-hour video on regulation 28, on retirement annuities, pension funds, those sort of things. But in short, what they do at the back, they also are holding a certain combination of index trackers or ETFs. So they look at certain themes that they think over the next 10 to 15 to 30 to 40, 50 years, because their pensions will generate a good return, and then they prefer to buy those. So, for example, infrastructure spending, health spending, um, yeah, things that may affect social welfare programs, education, that sort of a thing. They tend to hold investments in those types of vehicles, and those are called index trackers. So when the best leaves, the next best comes in and keeps on pushing forward. And then the last one, and the reason I put it last, is unit trusts. ETFs are automated unit trusts. Your fund manager used to do that back in the day. And the reason I put it last is because I want the old people in the session to just start forgetting about unit trusts. It's the same thing as ETFs. You're just learning 3 alphabets instead of a whole word. And I think I've had a conversation, Limbali, which we still have to have, about doing a video on trusts themselves. I think the word itself has more power than the concept behind these vehicles, but that's a video for another day. So let's get into our talk on index trackers. And I use an ETF. An 8-year-old explanation, if you will bear with me, says imagine an ETF like a magical basket of toys. Each toy in the basket represents a small piece of many different companies, like a piece of pizza from different pizza places. So when you have an ETF, you're not just buying one company's toy, but you're getting a whole bunch of different toys all at once. So imagine this magical basket that's got toys, and all those toys represent a share in an existing company, which is the case. I was a shareholder of Hasbro a few years ago. They're the guys that brought out Peppa Pig. They do the Marvel franchises. So by holding Hasbro, I essentially was holding all of these um, children's sensation franchises inside that one company. And ETF essentially does the same. You buy a representation of all of these companies, and then whichever toy is in fashion at that point in time, it goes into the basket, and the least favorite then jumps out and says, but you're getting a whole bunch of different toys all at once. This is like having a little piece of lots of companies all together. And the cool thing is, you can buy and sell this basket of toys on the stock market, just like you can trade your action figures or trading cards with your friends. It's a way for people to invest in different companies without having to buy each company's toys separately. So instead of going to Toy Kingdom or Toys R Us or what other toy shops were there when I was growing up? Yeah, nowadays there's toy palaces if you go to the malls. So instead of buying each individual toy, you just buy this basket that has got all the in toys at the time. And then when that falls out, you just buy a different basket and then get a new basket. And it says it's a way of people to invest in different companies without having to buy each company's toys separately. ETFs make it easier for people to have a diverse collection of toys from many companies, and they can be a smart way to grow your money over time. Now let's go to the 25-year version of this. And the person that asked for a 5-minute break, now is the time to sip your glass of water. The 25-year version looks like that, and I'm comfortable, Mbali, that since we'll be giving people the slides, they can go through them, but I also will be going through them in the next slide. Essentially, it's an exchange-traded fund, a financial product that's a bit like a combination of mutual and the stock. Here's a simple explanation for a 25-year-old. Again, according to ChatGPT, please don't throw tomatoes at me on your screen. Do that in the kitchen and have a legit ChatGPT. But here's what makes ETFs cool. The only 25-year word that I'm seeing there: diversification, liquidity, low cost, and I'm gonna touch on them here. An ETF, as we discussed with the 8-year-old, it's essentially a whole lot of companies, but you buy a fraction of their shares and you put it in this basket and you say, with my 100 Rand, I would like to own a piece of all the top companies. And they just have a way of weighting them. Normally, it's by market cap, meaning the biggest one will have the biggest share in your portfolio, all the way to number 10 or number 40, as we have the top 40. And that is how they decide how to weigh and diversify your money in that regard, right? The next big advantage of how they work and why you should use ETFs is also liquidity. If you're like me and you're an individual stock picker, you'll see that there are some companies that if you look at the stock price, it's something like whatever, 10 Rand. But when you go and buy it on a platform like I use Easy Equities, it says you're buying it for 11 Rand or for 10 Rand 50. That extra 1 Rand or 50 cents is because of liquidity. It's because there's nobody else willing to sell the share because it's so small and so few people hold it. They are then saying to you that in order to get it from somebody else, you have to offer a bit more than what the market offers. Why ETFs are a liquidity hedge, or they overstep the liquidity? It's because they actually assign a value and a weight to that share, and then you buy the basket instead of buying the share. In the background, the company goes and buys the share, but in the meantime, they give you the value of that share without overly complicating it. Then they're low cost. Again, if you have to get into one shop, speak to one salesperson, and then buy your Minnie Mouse toy, then leave that shop, go to the next shop, buy your Peppa Pig toy, leave that shop, get to the next shop, buy this. At all of those shops, you are incurring costs, fees, advisor fees, management fees, that sort of a thing. Whereas if you just get in and you buy a whole basket, they compile it at cost and then they just put an overall cost for compiling that basket for you. Again, the reason I'm using Peppa Pig and them as an example, I think you'll agree with me that it's a lot easier to think of it from an 8-year-old's perspective, right? Then the last one is transparency. Every quarter, ETFs have to report what it is that they have in their basket, and they also let you know what has moved out and what has moved in. And then you basically are able to keep track of what shares are in your basket or what toys are in your basket. The last one is choice, and this is the most recent one. As I said, when back when it was starting in 2010, for those of you that are my age, you'll agree that there was back in the olden ages of snow and stuff. Essentially, with choice, it used to just be the Citrix top 40. And I think that's the one that most people know. That's because that was the ETF that was the first to list in South Africa. And for a long time, that was the only exchange traded fund you could buy. Otherwise, you had to buy unit trusts from your Ellen Grays, your Alexander Forbes, and then fast forward a mere 10, 13 years later, and now you can buy ETFs based on any topical theme or factor that you want. So if you're looking for a sustainability ETF, then there's sustainability indexes that compile the best companies to invest in if you want to go green. If you're looking for women only companies, you can look for an ETF of women-led companies. If you're looking for, now it's topical that there's wars all over the world. If you're looking for ETFs that only hold companies that support your side of the war, I'm sure there's a manager out there that has created that ETF, and it is available for you at a low price. So it's basically like themed investing. It's like investing for what's that? Those yellow and black books, right? where you decide, I don't want to select my own companies. Can somebody else do it for me? And I just want to be able to say, I want the companies that deal with sustainability, women, and wars or no wars. And then you buy that with your single 100 Rand. Then what I've done is I've added to the slides the best performing ETFs. And I think I had a conversation with Tumelo yesterday or the day before. And she was excited to let me know that she's going to buy an RA and she's going to buy it from this company. And that's because it's the best. And I asked her, well, based on what? And you'll see that up there, I've essentially up here, I've put what ChatGPT had in 2002 January as the best performing ETFs, but more to bring more of your attention down here, where I say and the lowest cost, right? Because of legislations like ETF SA, what you have is that most ETFs will look similar. The only thing that will change is the wrapper on the ETF. So, for example, if you look at an Ashburton top 40 and you look at a Satrix top 40, it's exactly the same thing, except the company that sells the ETF, one is FNB and the other one is Satrix itself. Same with One Invest. If I remember correctly, I think One Invest is Liberty or something like that. Then you have Signia. So the top 40, you can agree that the top 40 will be the top 40. It just depends. You want to read it on Forbes, You Magazine, Huisgenoot, or what, right? And based on that, perhaps there's a translation fee, or I don't even know why there's a fee on some of them, but essentially that's all that you're buying. What then becomes the determiner for outperformance? It often tends to be low costs, and I put them there at the bottom with the fishes, because at the bottom of okay, this is one fish, it's one school of fish, but I said fishes because they're different types of fishes. Um, it's just a little OCD on my side. And it's because costs are essentially the one thing that determines outperformance. You find that an ETF will outperform, so generate good income, good returns, and then using our principle of expenses, the way they created that performance was through certain expenses. So, for example, if you say we're only going to invest in companies that don't have war or are involved in war, those companies may be few and may generate a huge return because we've had an exponential increase in wars in the last year, 2 years. But to compile that list and to essentially invest in those companies may also cost a fortune, because you would imagine you can't just go on the shelf and pick war. You essentially have to have men in eagles and suits and you name it. But essentially, the lower the costs, the more likely that ETF is to do well for you. And that concludes our conversation on index trackers. Um, you should have a lot of questions. There's quite a bit that I didn't add into the slides, not just due to time, but also due to, I always did say that I do like to have a lot of practicality. But in terms of the main things to consider, that's what index trackers are. And yeah, that then gears us up for our last topic, which is compounding, before we then talk about uh, concepts outside of the five concepts of financial freedom, which are emergency funds, equity, and capital. Okay, I'm seeing five um, chats. I'm not gonna look. I'll assume, Bali, that you will interrupt me.
Questions? Okay. Absolutely. Okay, I'm not sure. Can everyone hear me?
I can hear you now.
Okay, perfect. So I think maybe let's just take a moment to just get the questions out from my EFTs. Does anyone want to ask a direct question to Lesakhisha? I've also received some questions on the side that I can ask on behalf of, I mean, does anyone else have any questions they'd like to ask directly to Lesakhisha? Okay, so Sergey, the first question is, can you sit on ETFs and not have to track the performance of each of those shares?
Yes, that's the whole point of ETFs and not EFTs, Bali. You're gonna end up sending money to places you shouldn't. It's ETFs. So this is not like when you deposit money to somebody, guys. It's when you buy
Yes.
a basket of chips. Yes.
Yeah.
Um, yes. The whole idea of ETFs was so that you just have one basket that you're tracking the price of.
Mhm.
The mechanism itself tracks who is inside and how are they performing. And then if you're underperforming, it kicks them out and then adds a new one.
Okay.
Yeah.
Let me know if that answers your question. The second question was, can you buy these yourself? And if so, where? Would it be on a platform like Easy Equities? Are there other
Yeah.
platforms?
Yeah. 100%. Easy equities. Almost every bank offers them now. Yeah. So you can buy them yourself. In fact, Investing 101, I did mention in the last webinar that I do manage portfolios for people. But overwhelmingly, what we've always said is that if you're starting out and even if you're an expert, ETFs are one of the best ways to go. And I think some of the things I left out was, for example, the disadvantages to ETFs. And look, for I think those are more for us nerds. Um, at the end of it all, the benefits far outweigh the disadvantages. The disadvantages would be something like normally an ETF would not buy a company that is smaller than a certain size, for example. So that then means that if you have a dividend payer that, for example, some that I like, you find that a company is paying a 20% dividend, but its market cap is only 100 million, i.e., if you buy all the shares in that company, you're going to invest 100 million. You can imagine something like the Cetrix Top 40 or let's say the Citrix Divi that has a market cap of about 60 billion, right? If they were to buy that company of 100 million, they would be the owner of the whole company. So they normally would just leave a company like that, not because it doesn't pay a good dividend, but because it's so small that if Citrix descends on that company and buys its shares, there's no shares left for anybody else. And that would essentially create a monopoly where only the ETF companies own all the shares in the market. So, outside of little nuances like that, ETFs are the preferred vehicle that we do advise anyone that is starting out in investing to rather buy. Then you can save yourself a whole lot of fees from people like myself that promise you outperformance, but we come also at a very expensive fee.
Thank you. I think this is also a good question. Is it also a medium to long-term investment like shares? Where do you really see the benefit of profit?
Yeah, and if you've been in all three of these webinars, unless that's a question by you, Mbali, of which I'm mailing, nah, it's a long-term strategy. I always say that 5 years plus,
Mm.
and ideally as long as possible. And today's topic on compounding should show you why, right? If you're looking to do anything shorter than 5 years, listen to our previous webinar. You rather hold bonds, you rather hold cash, even for that matter. But if you're doing something 5 years plus, then that's where we start advising that you look into shares, ETFs, that sort of a thing. So they 100% are long-term products. That's actually why when you check even on my beginning slide, the people that hold them is it tends to be retirement companies, and that's because they can just hold them for 40 years, and over the 40-year period, they essentially just uh, accumulate and compound all of those returns.
Like,
Ooh, can you just repeat that, Mbali?
is there a minimum amount to buy ETFs? Maybe let's just add how much would you say, is a good amount to put in for my ETF?
Okay. In our previous webinar, I did indicate that that's a difficult rule because only you know your budget and your personal circumstances.
Mhm.
Ideally, I always advise my clients if you can put in 10% of your earnings, can be gross or net, as long as it's a hard and fixed rule that whenever I receive money, 10% of it goes towards this investing vehicle that I am engaged in. I would want you to increase that a lot more to more about 20 to 30% over the course of your financial life. But that obviously is everything dependent, economy, lifestyle, you name it. And so it becomes a bit difficult to do that um, from the get-go. So I normally advise just start with 10% and then see how you feel about that. You can go much lower. And I mean, I'll tell you, when I started with investing in shares, I initially wanted to start with 10 Rand. Obviously, the fees said that the transaction fees are the lower of 150 Rand or 1%. And once all those minimums came in, I think my first 10 Rand cost me 160 Rand to invest. Why I championed easy equity so much was because there were no minimum fees, no monthly fees, you name it. So as little as 10 Rand, you could go into the market and buy an ETF, which then just breaks your 10 rands into that weighting that we spoke about and buys the different companies.
Thank you for that. A question by Utumelo is, are we going to have a session on NFTs? Actually, that's a good one.
No, we're not. NFTs, crypto, I'm just trying to think. Yeah, those are essentially alternative assets, Dumelo. So although they have FTs in common and TFs, those are just naming conventions more than anything. But the underlying asset is not yet mature enough that it can be included in your conventional investing styles. And I think, did I include it? No, I didn't. But you'll see what we normally advise, right, is in your investing journey, do the correct thing 95% of the time and have that 5% in your portfolio for things like that. So if you have 100 Rand, 95 Rand, do the right thing, you know, buy your ETFs, select your mature good companies, that sort of a thing. And the 5 Rand on the side, because we humans and we tend to be drawn to speculation and gambling, use the 5 Rand for that. So buy your NFTs, your crypto, your lottery tickets with that 5% of your investment allocation. So if you're earning 10,000 Rand and I say put 10% towards investments, which is 1,000 Rand, it means of that 1,000 Rand, 50 Rand, you may invest in crypto and that sort of thing. That way you feed the urge and the FOMO without compromising your overall portfolio. And I always say, if those things are as good as they say they are, then this 50 Rand, if it grows 100 times, it anyway will grow to become 5,000 Rand. So if this thing is promising you a phenomenal return outside of the norm, as we discussed last week, you allocating a small amount to it will be overcome by the fact that it will handsomely reward you. So yeah, that's what I'll always advise. That way you don't compromise your entire investing journey.
Would you say that is it better then to invest in companies that, are digitally inclined? So instead of investing in the actual crypto, but maybe investing in a company that's within the digital space and buying shares of that company.
If you are me, yes.
Okay, so we all want to be Gashan. So the last question I had was just so I see how it's low risk, but aren't we over diversifying? Because my fear is there's like too many different, high risk strategies, high risk markets. I feel like you don't have control over those little things. Whereas if you are fixated with one company, it's easier to say, okay, I understand the markets, the risk strategy or whatever, and this is what I'm putting my money into.
Yeah, and those are some of the things I didn't touch. You tend to be over diversified But if you look at normally the benchmark is the market, right? And the market is normally ETFs. Um, and that just so happens to be that that's how it works out, that all of those companies acting against one another, you are then getting still a positive return. Because remember, if you're investing in the top 10 at your school, I don't know when you guys are having your 10, 15 year reunions, the top 10 tend to have done better than not. So it is over diversification. You will get the situation where number one or number three in the top 10 didn't turn out as you guys had expected. But overall, the top 10 did turn out to do well, and everybody just benchmarks on them or against that, right? On the other end, when we talk about, we call it passive versus active strategies. When we look at statistics, and there's the SPIVA report. The SPIVA report basically looks at the performance of active asset managers. They find that 85% tend to underperform the market. So when you're sitting at home buying shares for yourself, chances are you are going to underperform an ETF or an index tracker. And the number one reason for that is emotions, right? When you are just buying the top 10, your emotions are basically quite flat out. You don't care who's in the top 10. You're just going to keep on investing every month with no worries. Whereas if you have placed your conviction, your intelligence, your whatever inside one company, when that company goes down 10%, 20%, you feel like that's a reflection on you and your intelligence, and you tend to want to rather sell the company and buy something else that's winning. Ask any seasoned professional and they will tell you that the number one edge in investing, it's not the quality of calculations. I do the same calculations as all of my accounting peers. The number one quality of why people outperform and perform well is mindset, it's psychology, it's the ability to not panic when the rest of the world is panicking. I've got shares in my portfolio that are down 60%, and I'm not panicking. I'm even buying more of those shares. It's easy like this in conversation. If you are the asset manager behind that and your share has gone down 60%, you start to worry and you want to manage something and you doubt the calculations that you've done and that sort of thing. So those are some of the counter forces or counterbalances that an ETF gives you. It allows you that psychological break from interfering with your portfolio. And again, you'll see it with compounding, that the number one factor of compounding is time. If you are selling a share that you're supposed to hold for 5 years because in year two, a war broke out and you panicked, you don't get to year five and get to see that that company maybe would have benefited from the war, or they would have navigated the war in such a manner that they get to outperform what they previously would have. And it's for a simple reason. Wars, for example, create demand. They create demand for basic foods over and above what we normally would use. So we all are donating blankets, we all are donating canned food, we all are donating warmers and that sort of a thing. So companies that are in those industries, because a war breaks out, first they we all panic and the share price goes down. And as we start to realize that, oh no, actually this company is gonna benefit from this, then their value and their incomes tend to go up. So yeah, spot on over diversification, but it sorts itself out somehow.
Thank you for that. I'm just mindful of time, just a one-word answer. So if 5 Rand of the 100 Rand goes to digital assets, how much of the 95 Rand should go to ETFs?
Ugh, 50.
Okay. And there's a question from Umukhatla. He asked, and we'll just go to compounding straight after this. If I had a trust fund, would it make sense to earn gains and dividends into the trust fund for better tax benefits, or still stick to earning a natural person, or are the two treated the same from a tax perspective?
Just repeat the question if you don't mind.
So it's in relation to trust funds. It says, if I had a trust fund, would it make sense to earn gains and dividends into the trust fund for better tax benefits, or still stick to earning as a natural person, or are the two treated the same from a tax perspective? I think he means
Unit trust.
yes, I think that's in relation to the unit trust.
Okay.
No.
Ask a question. Thank you.
Morning, guys. So I'm just basically asking, you know how you can create a whole trust fund of a portfolio of assets, whatever it may be, and how it can operate as an individual person away from you. So I'm asking if earning into that specific trust fund would give me better tax benefits than earning them as a natural person, where the interest and dividends are coming directly into my personal accounts instead of the trust fund. So yeah.
Yeah, and that is far removed from what we're talking about today, index trackers. For everybody else, I'll advise you ask your financial advisor all of those disclaimers. In George's case, Mr. Makhatla's case, I am his financial advisor, so he's taken advantage and asked me on a public platform. Um, that's a conversation that, as I do say in Bali, hint, hint, wink, wink, we need to have on trusts and delve into some of these factors. And I think if I can just request everyone, we will go over time. I think it's evident to all of us. Feel free to jump off if you have other commitments. But I think I'll still just present the entire session for the sake of the recording, and also for those that are still able to make it. But on that question, George, in simple terms, 10 seconds, the way a trust works is that there's a trust deed, and in the trust deed, you nominate what must happen to the income from the assets that are inside the trust. So, for example, in your case, you will say 50% must come to me, Lesegisha. Then Lesegisha gets taxed in his personal capacity on that 50%. 10% must go to your unborn child. That will stay in the trust because they're unborn. And 40% must go to, let's say, yourself. Then you will get taxed in your own name. The amounts that stay in the trust itself get taxed at the trust rate, and trusts are taxed at the highest tax bracket in South Africa, which is one of the reasons why I want to record a conversation on trusts, because a lot of people have asked me about them and come to them, and I think preliminarily they're quite a bad vehicle from that perspective, because 90% of South Africans are not in the 45% income tax bracket. So if you take your 20% income tax bracket and form a trust, then leave income in there, you basically have just said to SARS, tax me at 45% and not at 20%, because I want to give my children my legacy, for example. And for me, that doesn't make sense. You're paying more tax, you're giving away more. That's the short of it. Yeah. Bali?
That's all for now. I think let's continue with compounding.
All right. And hopefully I can do this quick, but quick without losing the essence of it. Quick not because of time, but quick because it's compounding. Everything that we have discussed up to now, it's like planting a seed, okay? You plant the seed, you water it, the sun shines on it, the wind blows. Plant the seed, water it, sun shines, wind blows. And this happens every day for a certain period of time. And one day, a small sapling or those leaves shoot out the ground. And what happens in the next 40 to 50 days, you don't tend to appreciate it, but this plant starts to grow at a faster rate than what it was when it was still under the soil for 2 weeks, for 6 weeks. And you essentially sit in a situation where you go from having absolutely no visible sign that there's a seed under the ground to having a full fruit bearing, or not even fruit bearing, a vegetable bearing product. And I think, George, you can ask George for that. He's a farmer. And you essentially, yeah, that's the effect of compounding, where all of these principles come together and they create this super product that we now call food. And if you wait a week longer, then they spoil even. All right. Now, if we go to compounding, at its very core, when we look at what is it, it's a financial concept and it refers to the process of earning interest or returns on an initial investment. It goes back in and then it keeps on growing in that regard. The key elements of compounding, there are three of them. It's the principal, so that's the money that you put in. Then it's the interest, that's the return that it's generating. And then it's time, right? And of the three, I'll tell you for free, no pop quiz. Time is the most important of them. The longer you are investing, the better your outcomes will be. What most of us tend to do is we focus on the first two. I will start investing when I have got R1,000,000. Time beats you. Someone that started investing at the age of 15, and I think I will look at a compound interest calculator shortly between this and my conversation on emergency funds, just to show you the effect of compounding, right? Someone that starts earlier and puts in a little bit every month until they die tend to outperform someone that waits until they're 40 and they put R1,000,000 in. And we're gonna prove these numbers, right? That's on the principal front. Interest. All of us are chasing the highest returning items. I spoke in the last webinar and I said a realistic return is 9 to 15%. Anything above that, 90% of the time it's a scam. Anything below that, it tends to not be an investment and it tends to be a wealth preservation product. So something that keeps the value of your money or of your assets. So you're looking at property, you're looking at bank deposits, fixed deposits, government bonds. They tend to be anything up to 9, maybe 10% now that inflation has gone up. And that's because they're just tracking the value of inflation and making sure that they're giving you a guarantee on your capital and nothing more. So you essentially are looking at a gap of about 6%. That 9 to 15, you're looking at a gap of 6%. All of us try maximize this interest or return, and we go for investments that offer us 30%, 1,000%, 100,000%. And with that, the principle of risk reward comes into play, i.e., the more risk that you take. I know people tend to say the higher the reward. No, the more risk that you take, the higher the likelihood that you are going to lose your money. If you do survive that, then the likelihood is that your return will be high. But it's not a rule that says high risk, high reward. It's a statistical relationship that says high risk, ruin. However, if you survive the ruin, reward. Okay? And then time. Time happens to be the easiest one. All of us can wait. If you can't wait, you don't have a choice. Life will make you wait. You will turn 50, then 60, then 70. While you're doing that, we might as well pass time. If we talk to what is the most significant component, as I've discussed, it's time. Reason being, time magnifies the effect of interest. The longer your money is invested or saved, the more interest you can earn on both the initial and principal. Over time, this can lead to substantial growth. This is also, by the way, why your mortgages only come in 20 and 30-year amounts. On the one hand, it's because the principal is so big that it's not realistic that you'll pay it off in a year, but it's actually payable off in 7 years. How many times do we pay? I think someone's mic is on. How many times do we pay off a car, for example, for R1,000,000 in 5 years? Why can't we do the same for property, for example? And the reason that's the case, or the reason it's structured that way, is because you want a lower interest rate. And if we give you that lower interest rate in property, the way the bank then makes its money is that, well, pay 10%, pay 10% over 20 years instead of over 5 years. Because if you do it over 5 years, then I lose. But if you do it over 20 years, then you spend the first 7 years paying off interest and then the remainder paying off the principal. Time minimizes the impact of volatility. as I said, if you are contributing monthly into an ETF, let's say 100 Rand every month, when the stock market is down and you continue contributing, you are buying more units. When the stock market is up and you continue contributing, you're buying less units, but you don't get to experience that huge swing in the price of your investment because you're averaging in and out of that investment. Right? No 100 Rand will move the value of a 10,000 Rand portfolio in one day, but over a sustained period of time, it will do so. Compare that to if you buy one share at 10,000 Rand. When the market goes down, you factually can see that your 10,000 Rand has gone down. And if you don't contribute anything over time, you will experience that volatility. And then the last important component of why time is the most significant component, it provides the opportunity to benefit from the power of compounding. If you are getting 10% every year on a return, in 7 years, you've doubled your money. In another 7 years, you've doubled it again. 7 years, you've doubled it again. And in fact, the math actually shows that those 7 years become shorter and shorter and shorter, i.e., the first doubling takes 7 years. The next doubling, I think, takes something like 5.2 years. Then the next doubling takes 4.3 or 4.2 years. And the doublings just get shorter and shorter up until your money doubles literally every year. And we're talking about the, what do you call this? The installments that you're putting in. All of this I will illustrate for you on a compound calculator because right now it sounds like, my God, what is this guy saying? Hence I said the seatbelt, very important. Also the break or abuto the break, keep drinking that water, okay? Now if we go to why can't I catch up sometime in the future? As we said, the person that says at 40, I will just take R1 million and put in my share portfolio and I will be laughing all the way to the bank. And the 25-year-old that puts R1,000 every month and basically says, let's see who at 65 will have won this game. And I'm going to actually put those as the variables. 25-year-old putting away R1,000 and a 40-year-old putting R1 million. Oh, example, please don't embarrass me when it's time to show the numbers. Right? We'll have a look who ends up essentially making more money. Then, so there's less time for exponential growth. So the 40-year-old, I'm going to say 45-year-old. I'm not going to lose to you guys on an example. The 45-year-old essentially only has 15 years to compound their money from 45 to 60, whereas the 25-year-old has got 35 years to compound their money between that age and 60. And we'll see who then gets to benefit. As point number 2 says, you then need a larger investment to catch up with the other person. So you can't say, I will start at 45, putting R1,000 away. You know you're going to lose to the 25-year-old. But you start having to say, I'll put in R1 million. And you heard, even I wasn't certain if R1 million is enough. And I want you to note, I moved by 5 years. So we'll do both for a 40-year-old and for a 45-year-old. But that just shows you how huge the investments need to be. It means I'm not even sure if a 40 versus a 45-year-old with R1 million will outperform a 25-year-old putting away R1,000. That's the power of compounding. Then it says you need to take on higher risk and volatility. At 45, putting in R1 million, that R1 million better not lose money. Versus at 25, look, since I've been 25, there's been wars, 2 wars now. There's been a change of president. The Springboks have won 2 World Cups. My God, how old am I? Messi has won a World Cup. So all of those volatilities get sucked in. At 45, you only left with so many events. And so the volatility that comes in is few and far in between. Lifestyle and financial obligations, again, at 45, trying to take R1 million away from your wife, kids, your husband, and put it in the stock market so that you can catch up on time. Good luck on that. Whereas as a 25-year-old putting away R1,000, although it may feel like it's the end of the world, you actually are able to manage it a lot more than a 45-year-old can afford or will be allowed by life to take out R1 million. Then the last point is higher inflation to contend with. As you guys may know, in 1970, you could basically buy a house for 500 Rand. Today, with 500 Rand, you cannot even buy Monopoly to buy a house on. And that basically just says with the impact of inflation, because we know we have moved from the gold standard, inflation is just going to keep on getting higher and higher and higher, meaning that you will have a higher hurdle to fight and beat. Whereas the 25-year-old that puts 1,000 Rand away, their 1,000 Rand is only competing with 7% inflation today. Whereas who knows what your million Rand will have to compete with 15, 20 years from now. Then I then asked ChatGPT, how do I stop compounding? Because I wanted to know once it starts, can you even stop it? The only way is withdrawals, as you can see. And if you see the ChatGPT explanation for it, it starts with, although hard, withdrawals are the way to do it. The reason it says although hard is because once compounding has fully kicked in, it's almost impossible to go broke. I've personally been a witness to this for my own financial journey, where this year, March, I resigned. I then decided that I'm going to go full time. And essentially, I've basically stayed alive because of the financial concepts behind me that have been compounding, such that when I anticipated that I would run out of money, which was August, I continued to sail past that, not because I have a lot of money, but because I had so many financial products working towards sustaining me that it became difficult for them to just come to a crunch stop. So even with withdrawals, it becomes difficult for compounding to stop. And I think farming still remains a good example. There will be years, for example, where the farmer decides not to plant anything. And I think it happened with World War Two, and why the World War One, World War Two, and why the English. I use this example because Bali was in London shortly. They wear the red rose. I forget what they call it. The poppy rose, or the poppy flower, or the poppy seed. After they were done fighting the war, literally the only thing that started growing was the poppy seeds. And apparently that's because I think they had seeds in the soldiers' pockets, and they essentially then grew from there. That's how resilient compounding is. It just keeps on popping up and regrowing. Lower returns, lower returns don't stop compounding, they slow it down, but because it's compounding, you tend to have low returns, but on a wider asset base. Again, I think why property um, is popular, because if you're getting 5% on a 2-3 million Rand property, that is quite sizable compared to if you're getting 5% on 100 Rand. So one of the ways to stop compounding is obviously to get lower returns. Then reduce the distributions would be in the case of ETFs, as we spoke about earlier. If you're holding the top 40 and the top 40 is not declaring dividends, which they tend not to sometimes, then you find that the amount that needs to compound is very small in that regard. Then you've got distributions themselves. This is the case with pension funds. When they start paying you out your retirement amounts, you then have a lower amount that can then keep compounding. Then market fluctuations. Those of you that saw the headlines in 2010, if the market crashes basically at your date of retirement, you then are sitting with a situation where less money has to carry you through retirement, and that can then hamper compounding quite a lot. And then if you look at this is the underlying first principle. So I just compared it with engineering, again, just to make the example a lot more relatable. What are the things that are working underneath here? Why is this so difficult to stop? And the Mamelodi Sundowns fans and the Springbok fans will be happy to hear the example. Number one, it's momentum. It's difficult to lose when you've been winning. I think it was Vince Lombardi, someone quoted them one day. They said winning is a habit, not an act. So you can imagine once you start winning, it's difficult to stop. So it's momentum. That's the underlying first principle that's there. Then it's gradual acceleration, right? You put in 1,000 rand, it earns 10%. That's 100 rand that you've earned. You put in another 1,000 rand, that's same 10%, 20 rand that you've earned. 1,000 rand, 30 rand, 1,000 rand, 40 rand. And so this gradual acceleration keeps on making the interest or the dividend higher and higher and higher. And then we talk about persistence. Persistence, again, it speaks to the quality where even when you stop contributing yourself, the returns now are high enough that you cannot just stop the earnings just because you stopped the contribution. So it keeps on persisting. And then exponential growth. Imagine essentially you planting a seed every time that you put in a contribution into your investment, right? The reason it becomes exponential growth is because when that return, when that dividend comes back, that's not just a return. When you reinvest it, it becomes a seed itself. So essentially, I've got seeds producing seeds that are producing seeds that are producing seeds, and not just seeds that are producing fruit that you eat and then you finished all the fruit. And that's why it just becomes crazy. You've got seeds producing seeds that are producing seeds, and all of those seeds are creating trees that are creating their own trees, that are creating their own fruits, that are creating their own seeds. And it just becomes exponential. The mind can't even comprehend it. So much so that I decided to compile a list, 3 each, of artworks and songs that best capture the concept of compounding. Because if you like me, when you first think you comprehend the concept, you don't really comprehend the concept. But if you look at these artworks, The Persistence of Memory, Starry Night, and Spiral Jet by Robert Smithson, Vincent van Gogh, and Salvador Dali, those artworks, apparently, when you look at them, they basically give you the same appreciation for what compounding actually is. It basically just shows you that, oh snap, there's a lot happening on here. And how did we get here? But because it's in the form of art and not my voice on a Saturday morning, at least you can more or less get the mind blowing effect of it. Then songs, Don't Judge Me. I was listening to Imagine by Ariana Grande at 1 o'clock in the morning while compiling the slides. But essentially, you're looking at Time in a Bottle by Jim Croce. Essentially, what he says was, if I could bottle time, I imagine all the things that I would do. And sadly, what happened is that 3 days after Jim Croce wrote that song, he passed away in a plane crash. And they found a letter that he had written to his wife, and he had said that this is my last tour. I want to spend the rest of my life, the next 30 years, just at home doing all the little things that we couldn't do together. So it basically has that impactful effect of, oh, wow, what a crazy concept that this gentleman was running out of time and he wrote about a song about time in a bottle and what he would do if he could bottle time. And he wrote a letter to his significant other to say, essentially, this is my last tour and I want to spend the rest of time with you. Then Imagine by John Lennon. If you listen to it by yourself, you'll just cry, wipe your tears. If you listen to it with people, please do resist the urge to huddle up and swing side by side, singing those famous words, imagine all the people. In summary, compounding is a financial concept that refers to the process of earning interest or returns on interest. Compounding can work for you or against you, which is why when you rush to buy certain assets and you can't really afford to pay them off quickly, and you get into the liability side of those assets, you spend 20 to 30 years of your life owning nothing but one house and then wonder, where's this financial freedom that people talk about? You are essentially the bank's asset when you are holding a mortgage because they are compounding on you. And then the concept of compounding underscores the importance of starting to save and invest early, as it allows your money to grow more over time. It also highlights the significance of selecting investments with a favorable interest rate and compounding frequency to maximize your long-term financial goals. That concludes the talk on compounding. What I will do, Bali, and I know I will be your worst enemy for doing this. I do just want to quickly illustrate that example of a 25-year-old putting away 1,000 Rand versus a 45-year-old that puts 1,000,000 Rand. And then let's see what they end up with while I take questions. So you may take questions in the background, Bali.
Just in relation to what you spoke about as far as prepaying your bond. And I'm just thinking, if I'm acting for a lender in a banking and finance law transaction, and the borrower in the transaction wants to prepay whatever amount my client gave them, my thinking is the risk on my lender, on my client, is that the amount it receives from the borrower will be less than the amount that the borrower may have borrowed in the interbank markets, right? And it just explains what you were saying about paying paying in 30 years versus 5 years. So who bears the risk? Yes, I'm paying my bond off earlier, but who now bears the risk? Because someone needs to bear the risk in terms of the amount that the bank now is losing in the interbank markets. Is it in the form of cancellation fees? And how do those compare to me just paying in 30 years?
Bali said to me at the beginning of the week, you need to start invoicing me because the questions I ask you. And then she takes the first question and literally says, Sehi, Azish, do my work for me. Listen, there's no risk in that regard. If I can simplify it, remember, interest is the time value of money, right? So if someone early settles a bond or whatever, all that they do is they put capital in the bank's hands. So there's no risk because what the bank would have thought is a risk of default that they priced into the interest rate and spread it out over time. When you pay off early, that risk disappears because you are factually paying that thing, that what do you call it? That amount that you borrowed. So nobody bears the risk. The money just comes back sooner. If I'm correct, and maybe that's what makes your question multi-layered, unless I'm inventing questions in my head, because I was listening to you while filling this in. If the bank gives out a mortgage that's for 30 years and somebody essentially pays that off, but someone else had taken a position on the 30 years that's gonna occur or not occur. I don't know if that's the question you're asking. The reason I can add that variable to it is because that's what happened in 2008. You had people taking out bonds because bonds are safe, they are predictable, and they are long term. People started placing bets on top of those. And basically, you had this whole ladder of people that have got bets placed on the original debt. In this case, instead of the person paying it off early, they defaulted. When they defaulted, all of those relationships above the line basically then came crumbling down because the principal transaction no longer exists. Does that answer you, Bali?
It does, thank you.
My lord. Okay, so we have our 25-year-old that's putting aside away 1,000 Rand, and they're gonna put it away for 35 years every month. Forget the dollar sign. I think there wasn't a Rand sign, as you can see up there. I can use rupees if you like, because it's close to Rand, or is that rubles? And we just want to see how much are they gonna make. When are the deposits made? I said at the end of the period, because you get paid at the end of the month. And they're never going to increase. So this person is always going to pay 1,000 Rand and it's going to compound. I'm going to say yearly, even though in reality it compounds monthly. And the reason is the minute you put it away, the bank starts paying you interest. I'm going to assume you're going to deposit 1,000 Rand every month. And then at the end of the year, the bank will pay you interest on 12,000 Rand that you've put away. Our 25-year-old at age 60 having put away 1,000 Rand a month with an interest rate of 10%, will end up with, drumroll, they will end up with 3.4 million rands at 60. Now, some of you might be thinking, 3.4 million. This is why I rather wait until I'm 40 or 45 and put away R1 million. Let's change those numbers. Let's start with the 45-year-old. So they've got 15 years to compound 10%, and they're putting away 1 million Rand once off. 1, 2, 3, 1, 2, 3. And they've got no monthly deposits. So that's a 0. They end up with 4.1 million. So the 45-year-old wins, but you see how close it is as well, though. They would have put in R1 million and they would have earned 3.1 million, and the difference between the two of them would have been 700,000 Rand. Yes, in the background, you can hear me crying because I wanted the 25-year-old to win. But what I want you to not miss is the fact that it's 1,000 Rand versus R1 million at 45. And you taking the risk or the bet that at 45, you're going to have R1 million cash just to deposit into your investment account, right? And earn a 10% interest. As I said, we normally use 9 to 15. And at 45, for the remaining 15 years, you have to find a vehicle that will give you 10% and hope that there are no drawdowns. Whereas our 25-year-old that put in 1,000 Rand, they don't have to hope for anything. Everything gets swallowed in how long that duration is. All right. They don't have to hope that at 40 something they will have R1 million lump sum. And that also says nothing stops the, what do you call this? The 25-year-old, if they're in the same profession as you, if you're gonna have R1 million at 45 to put in, they also just then put in R1 million. And now they've got two investments, 1,000 Rand that they've been putting in monthly, plus the R1 million that they have at 45. But simply from a numbers perspective, 1,000 Rand over the 35 years, 3.4 million, and 4.2 million if you put in R1 million at 45. I'll take more questions, Mbali.
So, I mean, thank you, Lisakhicha and Bali. I hope that I can ask my question directly. I'm so sorry I had connectivity issues most of the morning. I had a question regarding ETFs and not compounding. If that's okay, if we can go back. Otherwise, I'm happy to ask this offline.
No problem.
Okay, so you mentioned that with tax-free savings, right? It's the only kind of investment that we can make with that kind, with the funds from there, is to buy ETFs, right? How do we go about transferring those funds from there and going and buying them with the ETFs without that tax implication?
So a platform like Easy Equities, the minute you transfer money into your tax-free savings pocket that they have, already there, when you press the option to invest, ETFs will pop up. So there's no tax that you will be incurring because you're not moving money out of tax-free savings account to a tax-free investment account. And I think the reason you have that question is because that might be maybe a setup. I haven't checked this, that some of the banks might have, where a tax-free savings account and a tax-free investment account are two separate accounts. I do not know for the life of me why they would do that, except it generates them extra fees when you move from one to another. I
Mm.
don't believe that it's even illegal because you essentially are confusing the public. And I think I posted a status yesterday on two Easy Equities to say, listen, a bad financial product for me is better than a confusing financial product, because a bad financial product, I can just do the numbers and essentially not invest in it. Whereas a confusing financial product, no matter which way I do the numbers, I'll always be in that unknowing land, in that unknown. And what you most likely will then do if you're in an unknown situation, you might say, ah, anyway, it's an investment. Let me just do it. And we see it a lot with the education policies that were sold in the 90s to our parents because it wasn't easy to determine how good they are. Our parents just said, I better get caught with one than without one. And then 20 years later, you're getting 300,000 Rand um, back, and we don't cover res or something like that. So I think it's one of those situations where if it is indeed the case, the banks might have just structured it that way. Um, it generates them extra fees, but also they strictly might also be sticking to an investment mandate that says Kanamefe's representative now, that basically says to them that give the client the option to put money in this pocket versus in this pocket because you don't have a license to sell ETFs. Yeah, but it's stupid nonetheless.
Yeah. Thank
Yeah,
you. Yeah.
yeah. You
Because I
are
don't
allowed.
think with
Yeah,
I don't think that with the one that we hold, or that I hold rather, with a bank, um has that option for me to invest. I'd have to just look into that, but I know that, and also, is it a good idea to have these, so tax-free savings in different institutions? Because I look at something like Stash, right? That's tax-free savings, right? And then you've got another one which is where you directly deposit. Sometimes it's a bit difficult to keep track of, how much you have put in, for the year, right? Seeing that it is 36,000 for a year and a certain amount for a person's lifetime. But would you advise for one to keep it in one place, and then keep track of it that way, or is it okay to have it in these separate places? And I know you're going to go to the fees. Yeah.
fees matter. Dumelo. Even if I wanted to, I can't mislead you. Fees matter.
Noted. Thank
Yeah.
you.
Keep it in one place. Something like easy equities, after you've hit your cap, they won't allow you to deposit into your tax-free savings. That's their way of protecting you against the tax penalty. Because that's the other thing. If you continue to put money into your tax-free savings above the required limit of 36,000, those extra contributions will get taxed at 40%. By the way, so it's free until the date's no longer free, then it slaps you
Yeah.
hard.
Yeah.
Yeah.
Thanks for that.
So you guys that are looking in the background, do you see what an extra 5 years does? It took your investment from 3.4 million to 5.6 million, same 1,000 Rand for our 25-year-old. And also what I wanted to show you there with the 35 years, you can tell I'm a sore loser by this, by the way. With the 35 years, the 25-year-old only deposited 420,000 Rand to get 3.4 million. Whereas with the million invested, you put in a million and got your 4.1 million. So you'd also have to add the fact that you've contributed 600,000 Rand more anyway. Sorry, I'm a sore loser. More questions, then I will wrap up with, let me just give you an emergency funds. The quick one on emergency funds, right? An emergency fund just protects your investments and your portfolio. Okay, it's an insurance against you. If you have life problems and you have 3.4 million sitting in the bank, earning you interest let me show you how crazy this is. Earning you interest of 281,000 Rand. This is in year 34 and year 35. Do you see how high that interest is? 311,000 Rand. is your interest. If you have a portfolio earning you 311,000 rands, I would never want to touch this 3 million. I would want it to continue generating that money for me. I'd rather find a way to live on my 311,000. But if you don't have an emergency fund and the bank comes and says we're gonna sell your house unless you pay off the 1 million balloon payment that you owe. I know houses don't have balloon payments. Then you are forced to kill your cash cow, take out 1 million, and then pay off the bond. And if we take out that 1 million, essentially we're back to this situation where your investment is worth 2 million and you're only getting 188,000 in interest. So that's why then it's important to have an emergency fund so that if the bank comes one day in year 30 or whatever and says, listen, interest rates have doubled in this 1 year. If you don't make your bond repayments, you're gonna default and you're gonna lose the house. Then you can go into your emergency fund and rather pay the extra amount required from there instead of selling your investment. So that's what an emergency fund is. In fact, I've always advised that you have an emergency fund before you even start investing. Don't trust yourself to build it while you're investing. Obviously, I'm human just like you. You can start both, but please never keep your eye off your emergency fund. That's the insurance product against you from your investments. That covers emergency fund. Bali, I'm not gonna cover equity and capital only because it's got absolutely no bearing on the 5 financial concepts to financial freedom. The work I do on YouTube covers equity quite extensively, so there's no added value that you're gonna get, except that it would have been nice to have it on one video. But those are concepts that are not gonna touch on anything that we have touched on today. And to the person saying, can we try wrap up at 11? I am done, or it's Mbali herself. I am done, save for any other questions.
All right. Thank you so much, Mbali, firstly for putting this together. And Lisakhicha, I cannot thank you enough for committing to these 3 sessions for the whole year with Sinothile. Like I said, I really do hope that this is not the last or the end, right? We will be one of those people who are long-standing members. Like this is just me making like an example with MacG's podcast, right? My uncle was so when it started picking up and it was getting a lot of traction, I remember him saying to me, I've been a chiller for so long. You guys are only, becoming chillers now because, I've been a chiller for so long. So I hope that we also have that kind of relationship where we can say that we've been within the financial empowerment corner for so long. And when people start catching on, right, when the bug does start biting, that it reaches the masses like we hope that it does, because this essentially is not only for us, but it's literally for our families, because we are here to learn about how we can improve the financial status of our families, and not only the families that we currently have, but also, or more importantly, the families that we are looking to build, right? Thank you so much. And I really do hope that next year we will have a bigger impact, right? Already the impact is huge. I mean, on my side, I think my investment decisions are more based on the topics that we've discussed, and my financial decisions are also centered around the things that we speak about here at the Financial Empowerment Corner. Thank you to everyone that has joined us. Thank you, Lisakhicha, once again. Thank you, Amina. Thank you, Mbali. Thank you, Christian. Thank you, Dumelo, and everyone else who did join us earlier. Thank you so much. Enjoy the rest of your day.
Yes, everybody.
Thank you.
Thank you, everyone.
Bye.